So good afternoon from London, everybody. This is the Sullivan and Worcester April webinar. I'm Geoffrey Wynne, and I'm partner and head of the London office. And the subject for today is increased opportunities in bank-to-bank lending. Good news for increasing trade finance and closing the trade finance gap. I did put this together before events in the US, and so this was sort of pre-tariffs and the Trump announcement. But we all like challenges, and I'm hoping that after this webinar there will be some increased views about how to deal with challenges. So what I'm going to cover today is a little bit of background to the whole issue of documenting trade finance transactions where parties are invited to join them, to talk a little bit about the importance of financing trade, but the obstacles, and then to look primarily at the two initiatives that are listed on the next bullet point to see if there's a way forward, particularly with smaller banks or with counterparty banks, but also then to look at some of the other options which are currently available, which could be changed to become available. To look at a subject that I've been very interested in, which is the involvement of non-bank financial investors, and then just to wrap up with a sort of where do we go from here. So on the background, there have been lots of initiatives, as many of you are aware, to encourage trade finance, in some ways led by the ICC, particularly on the digitalization of trade and whether the speeding up of trade and trade finance can be helped. BAFT and ITFA have both in different ways looked at what to do. Some governments are keen on encouraging trade, the growth of trade and trade finance. And then the regulators, as I've commented in the past, maybe a little bit behind in what should be done. But two key issues that come up are defining what a trade transaction is and then defining what trade finance is. These are issues that the documents that I'm going to talk about seek to address in some ways, but create some flexibility. And I think what we need in this marketplace is a degree of flexibility, and then a question of how concerned should a bank or financer be as to whether it is financing a trade transaction, whether its transactional finance is trade finance. And consequently, if it can get comfortable, will what we are looking at here help to close the trade finance gap of whatever number you want to choose, whether it's 1.5 trillion or more than that. But the ideas behind much of what I want to talk about are to make trade finance more attractive, or perhaps more accessible, and therefore to work out essentially what is trade, and therefore to explain this to financiers, investors, but the commercial parties involved in trade transactions, primarily suppliers and buyers, exactly why this is all relevant in order to obtain finance. And then the question is more involvement, but by whom, for whom, and so on. I've talked for some years about obstacles to financing trade, which invariably starts with this first bullet point, which is trade finance risky? And that's still a perception. And it's a perception that the regulator has in many different places, but also many of you involved in trade finance consider certain elements of trade finance to be risky, and fraud being raised a lot of the time as the reason that parties will not get involved in certain trade finance transactions in certain markets. And that takes you on to the next point, which is compliance issues, which particularly major banks have in relation to onboarding new customers, particularly the views that certain emerging markets are risky, and if you're risk averse, that you would keep away from them. But that's where the SMEs are predominantly wanting to access trade finance. And therefore, there is a lot to do. And can we produce ways that might help this? There's a lack of understanding about what is a financeable trade transaction. And that goes to the commercial parties, the suppliers and buyers, as well as those who are creating the transactions, be they major banks, be they platforms, and so on. And of course, a lack of understanding at the level, at regulator level, as to whether the sort of trade transaction and therefore the trade finance that we want to talk about is risky, is permissible, should be given better capital treatment, and so on. And then the question came, well, how would you involve financiers with access to funds? And one way that you might do it is to improve the KYC obstacles. Those are obstacles seen, as I said before, particularly by major banks about onboarding. But if you can create a situation where you as a financer can rely on somebody else's KYC, i.e. another bank's, you can rely on it and that's permissible, will that increase the way to increase what is available to be financed? And the question then is there a way to this via bank-to-bank finance? And that's actually what got me involved and a number of you involved in the two initiatives that I'm going to talk about in the next slides, but also to take you through some other possibilities of just how we can increase the availability of trade transactions, the availability of trade finance, and then what happens next. So let's look at the first initiative. Last month, Sullivan and Worcester were involved with BAFT and a very good working committee, as a result of which we published, or BAFT published, a new Master Trade Loan Agreement and guidance notes available for free to BAFT members, and I think at a cost to non-members. Now, what it did was it updated the existing version, which was published way back in 2014. And some say an update of a Master Trade Loan Agreement was long overdue. But the question then was, what would we do? And big headline, if you like, is that instead of doing minor updates, we took the view with the working committee and with BAFT that a complete rewrite of the Master Trade Loan Agreement could and should be done, whilst of course leaving in place the 2014 Master Trade Loan Agreement. And if we were going to create a new Master Trade Loan Agreement, then could we do something that made it more flexible, more available to the parties who might then want to use it? So if you look at the past, the original Master Trade Loan Agreement was created as a master document, but in some ways it was unclear as to who the parties to that should be. Clearly, a lending bank would be the lender, but was the borrower going to be any corporate borrower, or was it just to be a bank-to-bank document? And I think the the view was that it was probably meant for bank to bank. But one of the key drivers, given that there was a limited uptake in the 2014 document, given that it was clearly out of date, for example, it still referred to LIBOR, it didn't pick up things from Brexit, it didn't pick up the other changes that have been made. What should we do in order to get to a document that reflected the current market expectation, current law and current practice? And with the help of a working group, we launched a new master trade loan agreement, described as modular in structure, because it is signed as a master loan facility, but on an uncommitted basis. It contains all the provisions that you would want to get started for a longer term relationship between a borrowing bank and a lending bank. So it has definitions, it has mechanics, it has conditions precedent, representations and warranties, undertakings, events of default, and boilerplate. But what was different as we had the discussions was that if we replicated what was in 2014, then the master document would have to cover all sorts of different types of transactions, short term, longer term, different currencies, different interest rates, and so on. And consequently, we then came up with the idea of following master and offer an acceptance mechanism, which many of you familiar with the BAFT Master Participation Agreement would be familiar with. So you have a master agreement, but in order to make a loan, there would be an offer and an acceptance, a trade loan request, which is then made by the borrowing bank and accepted by the lending bank. We also created a concept of booking office, which meant that having signed the document, one branch of the bank lender to another branch to a branch of a bank as the borrower, you could, if you wanted to, and it was agreed between the parties, change the booking office of the lender to reflect the currency and so on. And also, again, if agreed, the booking office of the borrower as well. Would you want to adopt the Master Trade Loan Agreement? Well, I'm hoping that when I finished this presentation, you've had some discussions and seen some more, that it will become very apparent that this document is one worthy of consideration at the very least. So the headlines, what are the main changes? Well, what is there? Well, there's no doubt, as I said before, that you have a facility agreement that, using the offer and acceptance, will work to create, if you like, a binding trade loan each time there is a trade loan request made by the borrowing bank that is accepted by the lending bank. But the commercial terms of that loan are now in the trade loan request itself. That means the currency of the loan, the amount of the loan, the interest periods, the interest rate, and the particular trade transaction that is being financed all appear in the trade loan request. So that is multi-flexible. And as I mentioned before, the booking office gives you further flexibility as to, for a particular loan, trade loan as defined, who makes that loan, out of which office, and where the primary responsibility. We then created some optionality for sustainability, which is a very important aspect in certain transactions. But rather than build this into the master trade loan, it appears as an annex. Consequently, if you want to make a trade loan that has no dependence on sustainability, you're free to do so. If, on the other hand, following a discussion between borrower and lender, sustainability is going to be required, you can make a sustainable trade loan by operating and including the annex into the trade loan request, i.e. not changing the master, but into the particular trade loan that is made, that it will become then a sustainable trade loan. And that then creates as much flexibility as we can. And of course, we addressed the absolute requirement to remove LIBOR references, but allowed, again, the rate to be chosen with some example rates, again, in a schedule. But there are many places where you can find term SOFR, term SONIA, Euribor, and so on, in order to make sure that your interest calculations are in the trade loan request without having to make further amendments to the master, which will continue to run for as long as you want it to run. So therefore, what are the key features? Well, this is what we said. This is the summary of, I think, where we think we can get to. The first thing is that it is to be used between financial institutions. So this is not a document that we envisage will be used with commercial borrowers. So it's one bank lending to another bank. And it is to finance or refinance an underlying trade transaction or transactions. But you can specify those. So if it's a short-term trade transaction, that's fine. If it's a longer-term trade transaction where there are multiple drawdowns, you can deal with that. Where there are multiple repayments, you can deal with that. It is totally flexible as to what you can do. And its only rules are that it's clearly bilateral. So it was created as a lending bank and borrowing bank. Unsecured, uncommitted as far as the master facility is concerned. So you can safely sign the master and then await a transaction that you are happy to document using the offer and acceptance, or as we've said, using the trade loan request, which then gets accepted. So that is your whole framework. And you can consequently, you can, paper your transaction with a master and not have to renegotiate conditions precedent, representations, warranties, etc., unless you want to put something very specific into that document. The rest of it is then in your individual trade loan request and acceptance on that. How do we see the future? Well, there are sustainability provisions, as I've mentioned. Will they become market standard? I'm sure from the BAFT standpoint, they would like to, but we've seen quite a lot of sustainability provisions in the marketplace. Again, the advantage of the master is that if you don't want to incorporate the sustainability provisions from the annex, you can amend the annex, or you can create something else in your master. And we believe, and we hope that there will be a view expressed that this new master trade loan agreement is a response, and is a very satisfactory response to the wider market trends to enable lending banks and borrowing banks to cement a relationship which can then be dealt with the offer and acceptance mechanism. It's possible to incorporate the technology, in other words, to digitalize not necessarily the master, but certainly the offer and acceptance mechanism. Will there be further refinements? Well, that's going to be up to you on that. Like most of this, you launch a master at a particular time in the market when you think it's the right time. We would hope that the document is as up to date as it should be as of March 2025, and then we can see if any further changes might or might not be necessary. Incidentally, if you have any questions or comments, there's the chat and the Q&A button, which I will see, and I'll try and respond to any questions or comments at the end of this. But that was all I wanted to say on the MTLA for the moment. Let me move on. In some ways, and pretty much at the same time as I was working on the BAFT Master Trade Loan Agreement, I was having discussions with ITFA on the creation of a SWIFT loan template. So why were these two launched within days of each other? Well, the answer is, why SWIFT, not MTLA? The SWIFT is specifically designed as a one-off short-term transaction. So it evidences a loan for one purpose, and I'll come on to that in a bit more. As I mentioned before, the MTLA allows a relationship to be set up for a facility, which is then ongoing. But of course, the same idea or ideas is that both of these are between banks, in other words, not commercial borrowers. Both are designed to finance an underlying trade transaction. As I said, in the case of the MTLA, they could be multiple transactions. What you would normally expect in the SWIFT, that there would be a single underlying trade transaction, a point to develop in a moment. Well, why offer a standard? Well, ITFA's view, and if you like, my view as the person who held the pen in all these discussions, was that there were many variations in the marketplace. Banks were developing their own form, borrowing banks were developing their own form, and consequently, there were just many variations. And it was actually quite interesting just to see the variations as the working group had its discussions, to see what people were using in the marketplace. And the idea of having a template would be to save time in negotiation, because the parties could then have the same starting point at least. And as ITFA said, grateful to FCMB UK, who gave us a starting point for discussion. So we have a template. So what are the basics of a template? Well, the answer was recognizing that SWIFT loans are documented using the SWIFT 799 message, which of course is interesting in itself, because it means that the template is in capital letters all the way through. But it's used to make a loan from a lending bank to a borrowing bank. And the way it is structured, it is at the request of the borrowing bank to the lending bank. But it's designed to cover a commercial transaction, a trade transaction that the borrowing bank has with its corporate client. Therefore, it has had a very good use in emerging markets in particular. But it was a standalone short-term loan. In other words, it didn't rely on the market association, didn't rely on the BAFT MTLA. It was self-contained. But as ITFA said, until this template was issued, there was no guidance on the documenting of a SWIFT loan. And consequently, well, you have guidance, if you like, because this is how we suggest it be done. Now, it, of course, is up to the participants in the market that once you see the template as to whether it is acceptable in its form. So what it is what I would call it's a base document with guidance notes that offer options and variations. And the guidance notes also suggest additional wording. So again, as I mentioned before, flexibility remains the key, but you need a base. And the base was, as I said, it's an offer from a borrowing bank to a lending bank. That's how it's structured. And if you go to the last bullet point on the page, there are two ways of accepting it. You can accept it as the lending bank simply by making the loan, or as some prefer, you accept the offer and then make the loan separately. Those two options are there. The base case again is that it is a loan with a single interest period and consequently a bullet repayment. And as I mentioned, it is for an underlying trade transaction, the details of which you can decide as the guidance shows. But in simple terms, if it is a loan with a single interest period, even if that loan is based on term SOFR, term SONIA, Euribor, because it's a single interest period, you could actually simply put in the percentage applicable to that loan in the SWIFT message itself. So you don't have to have all the complex calculations if it has a single interest period with a bullet repayment. But as many of you pointed out, that's not always the case. So what are the variations? Well, the variations that are demonstrated are interest rate calculation. So we have put into the guidance notes a way of dealing with a floating interest rate with a margin, if you want that to apply, multiple interest periods if you want that to happen. How you describe the underlying trade transaction has a short form, has a long form. It's up to the parties to agree. We've put in what we regard as relatively standard representations, undertakings, and events of default in the base document, but recognizing that many of you have other requirements, the guidance notes indicate potential additional representations, undertakings, and indeed events of default. We've also, because this is a two-way document, we have indicated areas where a borrowing bank might want to have a look at the provisions, even in the base document, to see if it wants to negotiate lighter provisions, different provisions in the document. Because essentially there are events of default. So whilst the loan is designed to run for its single period with a bullet repayment, if there are defaults, the SWIFT loan can be accelerated early. We've also put into the document technical clauses that parties may or may not want, including set-off, assignment rights, and so on. So if you like, expanded boilerplate that for some of you may tick some boxes. For others of you, if you see it as what it is intended, which is a short-term single repayment financing, you have a base document, keeps it short and to the point, and we hope will facilitate more parties using the SWIFT for that purpose. And because there are a number of different jurisdictions, we've addressed both English law and New York law options in the clausing. We've also covered the use of English courts or New York courts or arbitration using an arbitral tribunal. So those points you can build in. The consequence of all of this is that you have a base document for that single loan. Make sure you read the guidance notes and make sure you incorporate only what you need for the specific transaction. You don't have to run it with all the options. We would expect the SWIFT loan to be crisp and simple, choosing the right law that you want, choosing courts or arbitration as you see fit. And consequently, and ITFA is having a further webinar on this, you now have an alternative way of documenting loans between banks using that SWIFT message basis. So let me pause for a moment and look at some other things. I've talked about loans, and I've talked about loans between banks. And I hope that that's helpful. I was talking to a smaller financing institution about long form loans and complexities. And it may well be that a number of smaller banks and indeed larger banks listening in to the discussion may well say, oh, yes, look, I like this idea. I like the idea of using these documents for unsecured financings, because that's what they're used for. Now, if you want secured financing, we're talking about something different. And I'm not talking in this webinar about securing a trade transaction which you're financing, but we can certainly talk about that at another session. But one way that is still a very popular way is for one bank to offer to another bank, be it a big bank or a small bank, participations in its underlying trade transaction. And a very simple way of doing this, which I'm pleased to see is still very much in use, is a BAFT-style master participation agreement. And for those of you who may remember 2018 and 2019, we revamped an English law and a New York law BAFT Master Participation Agreement. Please don't use the 2018 or 2019 ones because they referred to LIBOR, and in 2020 or so, we've removed LIBOR. So the up-to-date BAFT documentation now removes the references to LIBOR, puts in central bank rates, and gives you a master document that you can sign up under which you will grant participations in your underlying transactions using the offer mechanism in BAFT. Remember, I referred to that offer mechanism for the Master Trade Loan Agreement. This is now a well-developed means of offering participations using the BAFT Master Participation Agreement. What is interesting to me is that when we wrote the original, we just put some headers in as to what you might put into your offer. What is clearly happening, which is good news, is that offers are becoming very much more stylized as participants join transactions originated by the seller, as we've defined it, and they're using the offer to modify what belongs into the BAFT document. And just a reminder that the BAFT document in 2018 had receivables financings just as an addition that's contained in the guidance notes. I think if I were writing a BAFT today, that would definitely go in to the BAFT document. But what is clear from the structure of the BAFT Master Participation Agreement is that it is very useful in granting direct rights to the participant in the underlying transaction. And for those of you who've listened to my webinars and others, it is done by way of an equitable assignment with rights of what are called elevation. But what it means in a transaction using BAFT, as indeed in a master loan, trade loan, the seller, borrower in the other one, keeps the relationship with its customer, accepts some limitations as to what it might do as against the participant, but essentially having granted the rights in the underlying transaction, having accepted some controls, the transaction runs either on a funded or on an unfunded basis with the participant either funding or taking the risk in the transaction. And the BAFT Master Participation, with its offer mechanism, can deal with all of this, can provide the flexibility in relation to underlying trade transactions, which themselves can be multiple trade transactions. It's just a matter of drafting in relation to the offer. So we see quite expansive offers being used to cover underlying transactions. And in no way do I think that these two documents, the Master Trade Loan Agreement and the SWIFT loan, will supplant the BAFT documentation. These are just alternatives. And as I said, I remain very keen on seeing participations using the BAFT up-to-date master participation agreement, using a more specific offer and acceptance mechanism, which means in some cases writing quite extensive provisions in the offer to cover the specific transaction, but you have the master sitting there with all its boilerplate protecting the mechanisms going forward. So it remains a very good way to bring others into the financing, but very much on a bank-to-bank basis. Why? And I'll develop this in a moment, because it assumes that the seller provides the details and the document to the participant, and it is for the participant to assess not just the underlying transaction, if you like, from a credit point of view, but from a documentation point of view. So there are very little representations and warranties from the seller in a BAFT transaction about the underlying transaction. That means its suitability is limited to a participant who is prepared, if you like, to take not only credit risk, but also documentation risk in the underlying transaction. So having said that, if the BAFT is so good, why did we need something else? Well, as many of you saw about a year ago, ITFA provided a master account receivable agreement. Similar structure to BAFT, master document, two-way, but said this should be used for receivables and payable structures, and only for receivables and payable structures. And as I said, it develops, if you like, from the BAFT document into the specifics of what you would put into both receivables, i.e. where you buy from a supplier, or payables, where you have direct claim against the buyer. It's another way to share funding, to share risks, and to share rewards. Do you need a master? Well, you have a master if you want it, and it operates on a two-way basis. So for those of you who want to enter into master documentation for receivables and payables, this ITFA MORA will work for you. Having discussed it with some people regard it as too complicated. Others regard it as a bit one-sided. It favors the seller. And again, as I mentioned, one of its issues is, does the participant, as well as taking credit risk, also take documentation risk? And is there something that you should do about it? Because what I'd like to do in the next few moments is just to develop the thinking in relation to how you might participate your transactions between, if you like, funding parties. So what I looked at is a discussion subject that I've been quite keen on, and is an ongoing discussion, is, has anything that I've been talking about today worked for non-bank financial investors, particularly, if you like, funds, pension funds, and so on, who actually want to make investments into trade transactions, but want to take essentially credit risk of the paying party, might take performance risk, but certainly don't want to take documentation risk. So the consequence of this is that if you are looking at being involved in trade, do you want to see a definition of a trade transaction? And the answer is that is quite likely to be yes. And therefore, if you look at what a trade transaction is, as we've tried to define it in other places, including the uniform rules for digital trade transactions, a trade transaction is a sale and purchase between a supplier and a buyer of goods or services. So supplier of goods, supplier of services, buyer of goods, buyer of services. And that's a trade transaction. And therefore, there will be mechanics as to how you want to finance such a trade transaction. Now, I can take you back to the beginning of the discussion today, which got to the borrower bank in both the MTLA and in the SWIFT, deals with that between itself and its customer, and turns around and says, here's my trade transaction, I'm financing it, will you lend me money? Or in the BAFT, will you participate with me? The question, of course, for an NBFI is, thank you, if I'm going to invest in trade finance assets, how do I make this investment? And there are a number of different ways. And that's a much wider discussion than today. And I'm working with ITFA, with the ITFA transaction. I'm talking with the ICC as well, as to how we can use all the different mechanisms, including uses of platforms, of SPVs, of securitization vehicles, to create a discussion as to how we can increase the potential of trade transactions that can be financed and consequently are financeable, turn them into trade finance assets, and therefore finance them. The more discussion, in my view, about this, the greater the understanding is likely to be as to what we can do to enhance the ability for parties to want to get involved in trade finance, and indeed the financing of trade finance assets. Lots of ideas around and issues, and therefore I want to spend the next few minutes looking at perhaps a list of where do we go from here. So let me remind you that the main purpose of this discussion was we have two new documents with guidance notes around. We have the BAFT Master Trade Loan Agreement. Now, it is less than a month old, so I have no indications yet as to whether it is actually being used and being signed. What I have had, and which is good news, is I've had a number of people saying, a number of banks saying, this looks good, I am going to have a very close look at that. And if that is the case, and those who are looking at it are lending banks looking to go and talk to their potential borrower banks, then we have made a great deal of headway in raising the visibility of this new Master Trade Loan Agreement with its mechanics. Now, the SWIFT document is even newer. So I haven't heard, but some of you on the call may have already tried a transaction using that new form of SWIFT loan. And that will be important to see what the take-up of that will be, because if the take-up of that is great, if the borrowing banks see it as a useful way forward in their discussions with lending banks, then again, we will see the growth of SWIFT loans the short-term loans to finance underlying trade transactions. And that will mean the answer to my second main bullet point was the updating worthwhile. The answer to that will be a definite yes on that. And I'm certainly hoping that that will be the case. Modernizing documentation, keeping it up to date, having more, if you like, shorter form documents available in a marketplace, less optionality, more flexibility. And that is absolutely a requirement on that. So what about the other documents? Well, you are all using other documents. There are other templates around on the lending side. There are the longer versions from the Loan Market Association, both in its major documents, in its emerging market documents. So your options on the lending side seem to me they've been enhanced a bit. One question for you is, should there be a New York law version of the Master Trade Loan Agreement? That's a discussion with BAFT. Would you have a lender-borrower template? I'm not sure you would, but there's a possibility. We started the discussions on the Master Trade Loan Agreement as to whether there should be some options in a schedule that dealt with commercial, if you like, corporate borrowers rather than lenders, and the decision was there not to do that. So let's see. But what about the other documents? Well, I've sort of intimated that you are all working very well, if you like, amending the BAFT master participation agreements using the offer and acceptance mechanism. Are there better structures? Well, with the MARA say yes, but better structures for whom? And that's really the question, because I do want, if you like, to whet your appetites about saying, well, if banks are comfortable with what they're doing with each other, using these documents, using platforms and so on, who else is interested? And that gets me back to the NBFIs, the funds, who may well see the current documentation as being too bank focused, too focused on participant taking responsibility for documents, and wanting something simpler that deals with, I take a credit risk, a performance risk that I can evaluate. You've got to tell me that the documents are good. And that may well mean that we start moving to, if you like, one-way structures like borrower-lender, but one-way seller and participant as we've documented, but some standard forms, some standard ways of looking at it. But one way or the other, the idea is to make entry into trade finance more attractive. But is that enough? And one of the discussions that I've been having and others have been having is, are there other ways to bridge that trade and that trade finance gap? ICC very much on a digitalization, which we of course support, but many of you may not want to do that. And one of the questions that I've been raising is, can you make trade finance assets better? And what does better mean? And that takes me back in the first step to the regulators, to ask the regulators to relook at their definition of, if you like, self-liquidating, which came up in the context very much of letters of credit, and assumed that self-liquidating meant that, if you like, the issuer of a letter of credit, because it had the title documents presented to it, could self-liquidate by selling the goods if its applicant, its counterparty, didn't pay. That was too restrictive, too prohibitive, and we still have issues about trying to define short-term trade to get better regulatory capital treatment for major banks, which I'm still hoping we can address. If the EU won't address it, that the UK may well address it in its approach to Basel 3.1, and then perhaps the rest of the world, Singapore, the US, and so on, can have a look at that. But also, can you make trade finance assets better quality? As we discussed many years ago in restructurings of actually the Kazakh banks as an example, as to whether the quality of the payment obligation of a buyer can be improved. That would then, I would suggest, make the trade finance asset that an investor is financing of a better quality and encourage more parties to join. Now, you can do that, of course, at the moment. You can have guarantees, you can involve the DFIs, you can have credit insurance. All of those are there, but are there other ways to do it? And of course, my point there is that this is, in some ways, this goes much beyond what I was talking about. And these are issues for another day. I welcome emails to suggest other areas that we can discuss in our webinars, because there is a lot to discuss in relation to the financing of trade that go well beyond these two new documents. I'll pause now if there are any questions. Let me just have a look if there's anything on the Q&A. One of the questions was, how do you control the use of funds if you're making an unsecured financing? The answer is you can build that in on that. But if you're using a master trade loan agreement, we're assuming that you are dealing with a relationship party. If you don't trust that relationship party, I don't think you'll want to sign the master, and you certainly won't deal with the trade loan request. But remember, you're not taking the risk in the underlying trade transaction on that. Your credit risk is your counterparty bank on that. Whatever monitoring you want goes in there. But remember, the master trade loan agreement, as I said, is for an unsecured facility on that, but it allows your underlying borrower to deal with his relationship with his customer. But he comes to you having signed up the master document and says, look, this is what I want you to finance, and then you can put in whatever you want. But you don't get, well, do you get any more protections or priority if the borrower goes insolvent? No, you don't. What you've got is you have a claim in these situations against your counterparty bank. Now, I can give you lots of ways of enhancing that, even without taking security, is, for example, having your counterparty borrower have an account at your lending bank into which the proceeds of the underlying trade transactions are directed, giving you the potential of set-off and so on. What I'm trying to do for the moment is to encourage this sort of discussion, which says, hey, I can see there is a new way that I can finance relationships between banks and to give me more flexibility. Another question, how is the ITFA SWIFT fundamentally different from SWIFT commitments used in banking? So, well, the answer is it is not fundamentally different, and indeed is not designed to be fundamentally different. What it's designed to do is to take, if you like, the collective wisdom of the working group that ITFA put together, look at what was in the marketplace, and to produce a cleaner, shorter version that has, if you like, a logical structure with a minimum satisfactory way of evidencing a potentially large number of transactions in that short-term SWIFT market on that. Do I think it's better? Well, since I held the pen, I would have to say, yes, of course, I do think it's better. But in reality, it'll be for you to decide, for you to look at it, to consider whether there is anything more or not that you want to put in. If you like the layout and the format, that would be very interesting. As far as I'm concerned, that would indeed be very interesting to get some feedback on that. Hang on, let me see. I don't think I have any more questions. I'm just checking. There is nothing more I can see on that Q&A. Oh, sorry, there is one more question. Am I aware of Sharia law versions of the templates? No, I'm not aware of Sharia law versions. I know there is a Sharia law version of the BAFT Master Participation Agreement. What would the banks need to think about if there were to be a Sharia? Well, the answer is, can you have a satisfactory Sharia compliant lending document? The answer will be depending on where you want to use it. I think if somebody wants to address that to BAFT, and BAFT might have a think about whether there is an interest in the marketplace in doing this, creating some sort of equivalent for that would be Sharia compliant. Certainly within trade, it is possible to do that, but not in an unsecured lending context, would be my view on that. I'm just one last check. I think we are done. So on that basis, thank you for your attention. I look forward to seeing you, hearing from you at other sessions in person on transactions. And I, most importantly, can't wait for some feedback on the BAFT MTLA and the ITFA SWIFT loan in particular. Thank you for your attention. Happy structuring. Thanks. Bye for now.